Michael, this is part 2 of the Matador deal. In the first part of this deal, in our new evaluation using combo curve and well database, you covered how to set this deal up in part 1. This is part 2, where we really get into the type curves and coming down to the bottom line number. Is this deal worth what you're paying for it?
Absolutely. Part 1 was the sizzle. Now we're about to get into the steak. So let's do it. All right, so we need to go in here and create our type curve. So let's go ahead and create a new type curve here by just saying create type curve. They make it really simple for you. Wolfcamp A, we'll call this type curve. We got to make sure we select our field forecast, and that's pretty much it. We'll use best fit. We want to use rate, ratio, blah, blah, blah. And now what we're going to do is get a nice overview of exactly the productive quality of all of these different wells. So nice. Here's kind of the standard view I like to look at. Right here, this is the production curve normalized to time 0. So when you hear normalized to time 0, this assumes they all launched and started producing the same day, aka time 0. So you can get an idea of a well's performance relative to each other. We see right below that is a distribution of the overall estimated EUR. What is EUR again? Estimated ultimate recovery. How much oil is the well going to make? And you can see the distribution laid out with your P90, your P50, your average, and then your P10, which is again just distribution numbers. Anybody that comes from statistics would tell you that those numbers are backwards. P90 should be your best and P10 should be your worst. In oil and gas, we like to think we're smarter than everybody else because we are, and we flip it. I'm just kidding. You actually dumber than most people. So our P10 is the best. P90 is the worst. Right here, you've got a little bit of a map that shows you, okay, here are kind of where those wells are relative to each other. So we can see we have a nice little conjunction here. We've actually got one well that we stepped out here, the James Ranch unit, 2020. We got a landing zone in the Wolfcamp. It's an XTO well, interesting. And then here, what we have here is our perf lateral length, okay? And so what this shows us is what is the lateral length versus the EUR, aka at a 4,000 foot perf lateral length, we've got a 400,000 EUR. And what this is going to help us do, and what this data is going to help us do really is normalize. Because what we need to do, remember Stu, what do we need to do? We need to mile 2.5 mile laterals or 12,000 foot laterals. So we go 1-to-1 fit, and this is going to allow us to create a fit based upon 12,000 feet. Okay? So now we're going to be able to do copy to all phases. We're going to normalize. And now what's going to happen? We're now going to see that we have EUR multipliers on some of these. See? Some of these, Stu, have a 1.2% multiplier. What does that mean? It means their lateral length was shorter than 12,000 feet. So we need to upscale this average EUR in order to account for the fact that there's more theoretical productive lateral length. As always, there's risk to this. You don't know that drilling farther in the formation is going to do this. But yeah, we have to make some assumptions here. And again, this is another assumption that we're making is that the lateral throughout this entire 12,000 foot lateral is going to be just as productive. You could argue it's not. It's part of the reason why I use 1-to-1 because it takes each individual well into account versus creating what I would call a linear fit, which is one line that is the average of all of them. So there are ways to mitigate that risk. Again, that's why I choose 1-to-1 versus linear. You could also do a two-factor fit. I tend to find that 1-to-1 works best. But again, the goal is to come up and align your own workflow. So now let's come over here into the fit. Let's go ahead and make sure here we've got enough stuff. We want to make sure that we're not crucifying these here. So I think these factors will work. Let's go ahead and just run it and see what our type curve looks like. Boom. We like that.
I do too.
Now, something interesting that pops out to me on this, okay? So let's go ahead. I don't really care about the cross plot. Let's go look at our type curve fit. But let's see what our gas looks like. Let's go ahead and switch this to gas. Okay, so you've got some good stuff here. Here's what scares me a little bit right off the bat, Stu. We've got our EURs up here, okay? So let's go ahead and expand this. I'm seeing a big distribution here between our low end, our P50, our best fit, and our P10 fit. Now, a lot of them have similar IPs, but what I'm seeing is, we kind of zoom in here a little bit, there's a little bit of a variance right here.
Right.
Which is a little bit cause for concern. What we would love to see is everything stacked on top of each other. Our P10, our P50, our best fit, and our P90
Right.
were all one number. Because what does that mean? That means you have less variance. And one of the ways that combo curve makes it easy to discover this is what's called a probit plot. Now, this is something that we could do in Excel, but again, combo curve makes it easy. They give us the statistics for us. So let's go ahead and turn the legend on. Here we go. And here's the big thing I like to look at. P10 versus P90 ratio.
Nice.
What that is the ratio between your highest distribution, in this case our P10, and our lowest distribution, and it gives you a ratio. The higher the number, the more variance your data has, aka the cause for concern. Everybody has their own numbers in mind from a ratio. I think the first question you're probably asking is, well, what ratio? What's a good one? What's a bad one? 1 is the best. Think about it. 2 numbers divided by each other is 1. 1's good. 1.5 is good. 2's good. 3's getting a little worse. 4's okay. You start getting 5, 6, 7, 8, 9. Understand that, okay, yeah, I still am confident maybe that my distribution is correct, but you're going to need to test all of your different P10, P50, and P90 cases. And if your P90 case isn't profitable, watch out, because there's a chance it happens because your distribution is way. So that's what I would say here. So in our case with a 5.6, we should probably run a P10, a P50, and a P90 scenario. You should probably do that. We will probably just run a P50 for time's sake. But in what I would call a legitimate data room, I would flag myself right here and say, whoa, we're going to have to run all of our different scenarios because I think that's too high of a variance. But it's the power of combo curve. We were in 20 minutes able to figure out, hey, we're probably going to need to dig into these more. And that's, I think, the critical part with a lot of these deal valuations is, especially if you're in a high-flying environment where you're getting deals coming at you quickly and you need to make decisions quickly, you got to look for the fatal flaw quickly. And you have to be able to identify the fatal flaw quickly, because if you can't identify the fatal flaw, then that's in your mind, maybe this is a deal worth doing, and there's some more due diligence involved. And so right now, if we're talking about a fatal flaw in this deal, this would be a cause for concern. Is it a fatal flaw? We'll find out. But what we need to do now is we need to come back and create some single well forecasts in order to then create a scenario. And remember, what was it, 6 wells, Stu? Yep, it was 6 wells. So Wolfcamp A, and we'll call this the Simon number of wells, 6. We're just creating some generic wells here, okay? And what this is going to allow us to do is come back to our project. We're going to create a new forecast, and we'll call this the Simon Wolfcamp A Simon single wells forecast. We're going to filter our wells, and we're going to select just the ones we created. We're going to apply. We're going to apply. And now we have 6 blank wells here with no type curve. Well, what do we need to do? Well, we need to go load our type curve in for all of these. Okay? So here's what we need to do. We need to come in here. We need to go add type curve. Pick our first production date. Pick our Wolfcamp type curve. We'll take best fit. Oil EUR 444,000. Not horrible. We'll go ahead and apply it. Look what happened. Now we have a type curve. And so with just 6 wells, it makes classic sense, Stu, to just come in here and do this for each one, because we need to make sure our first production dates are correct. Remember, we've got 2 that spud in February. And 4 in April. So I already got this one wrong. So we'll have to go back in and reapply that type curve. We've got all of our type curves loaded. We've got the first prod dates is April, February. And so now we've got what we would consider a type curve for each well loaded into combo curve. Now let's go create our scenario.
Nice.
You said something interesting earlier, Stu, about Matador, their stock price. You're selling them?
Oh no, I've been making money on Matador personally, just playing on the market. And I was looking at my charts. Monday, 5th of June of this year, my charts showed a buy. And as you jumped in the type curve, then my automatic trailer kicked in. And normally a 5% trailer is what I put. On Monday, October 16th, it kicked me out, and I'm watching again for the stock buyback, and I'm now targeting about their $62 range is what my chart is showing as a buyback. Again, I give no personal advice. I mean, no investment advice, but charts don't lie.
I don't give investment advice, but here's my buy and sell signals. Love it. Love it, Stu.
Hey, it's just what the chart says, dude.
I'm giving you a hard time. I'm giving you a hard time. No, you've been very successful trading oil and gas stocks. I'll give you credit because I've had a terrible luck of it.
Believe it or not, Enphase is a solar chip manufacturer that is now back on my radar. Go figure that one out.
Interesting. So quickly, guys, what I did is I just set up my general settings here. And this is something you're always going to have to do, especially if you have a new project. You could go ahead and get your general settings from other projects if you wanted to, but I like to just create my new general settings per project. Aggregation date, it's just the date everything starts. I like to change everything into barrels, MCF, dollars, so it's easier to read. Discount table, I keep the same. So here's that level, 10% discount we'll be looking at, but here's some other levels we'll be looking at. So again, key is we want to aggregate this come January 1st because that's probably the effective date of this deal. And now we just got to go start adding all of our stuff. What's this right here? Choose reserves category. We'll call this probable undeveloped, or what we would call PUD. Save as. We'll use the model on all of that. We got to just put a base model in here. So we're just going to put this in here for now. And we'll save this. We'll come back to the working interest in a bit, Stu.
Okay.
Save as. Our dates. So remember, we'll probably put the as of date as January 1st again to line up with our aggregation date. We do want cash flow prior to as of date. That's critical. And we'll call this Jan 2024, aka because CapEx, aka jibs, are due before that. So
that is correct.
Once we get in and start modeling CapEx. So drilling, remember, these comes out in one unit. So this is all based on 100% working interest. So we know $13 million, and this is in millions, okay? Don't be fooled. It's going to come minus 30 days after, or minus 30 days before the first production date. Okay? So we know that we're going to get hit with a bill 30 days before drilling. It's usually how jibs work. 13 million CapEx. Save that bad boy. Use the model. We're going to go ahead and get our strip pricing. And this is where combo curve makes it so great, is because instead of using a flat price, Stu, we can go ahead and get ourselves the strip pricing.
I love it.
And we know based upon our little data room here that, I don't have it on here. Well, I remember it. It was a 35% NGL oil to oil price percent. So plus, and then what does it say? 35% NGL. We're going to save as. We're going to use that model. No differentials in the field, but we do have some different stream properties. And remember, there's natural gas liquids associated with this. And conveniently, we got this 70% shrink. We've got the parameters that we need. So let's go and fill that in right now. We'll move that over. Our NGL yield, love it. About 140 barrels. That's of unshrunk gas. BTU content, 1,400. And percent gas remaining, 70%, because we've got a 30% shrink. And so there is how you would load in, and we'll call this the Simon Wolfcamp A Simon NGL streams. Save as. And now, just like that, You've modeled NGLs. It's hard to model NGLs. People don't like to do it. Combo curve makes it so easy to do that. Now, expenses. This is where it gets spicy. Everybody has their own expense model. What does that look like? What does it not look like? I'm going to go ahead and say, okay, for simplicity here, simplicity people would say fixed cost or dollar per BOE. Well, we could do that, but I like to have a mix of variable and fixed. I know for a fact that these wells are probably going to have $7,500 worth of fixed expenses. Probably, if we're being honest, I'm going to change that to 10. Why do I think this? Think about it. These are new horizontal wells. You've got electricity. You've got pumpers. You've got COPUS that's going to get charged to the well. It's probably $1,000 of COPUS. Not that's going to be all to you, but you're going to have to see that. What is COPUS, if you're asking? It's administrative fees. And the operator can charge really whatever they want. It's up to you to accept whatever that COPUS charge is. So I'm going to assume there's about $10,000 a month of fixed expenses. I'm going to assume they have their own saltwater disposal systems. They better. And let's see if we can go back to their earnings report here. Let's go see if we can find anything about their water production. I know I saw a slide in here that was talking about their takeaway. Midstream. We got midstream. We know they'll be sending that. Strong well results. We love that. An integrated midstream strategy. Good thing. Record production. 3,400 barrels per day. Woo! Crazy.
That's a lot.
So I'm going to assume they're disposing of it via a saltwater disposal well. You have to. You're drilling 6 wells. You've got to have a disposal on site. So we're going to assume a saltwater disposal. What we're also going to do is, I noticed this, Stu. They broke down their operating costs for us. LOE, nice. Lease operating costs, $5.34. Now that's total. And now that is what we would call unit operating cost per BOE. This makes it, again, this wraps everything up into one number. So we could either use that number, $5 per BOE, and just call it is what it is. Or we could, again, do what we're going to do is say, okay, it's probably more like $3 on top. There's probably $10,000 of that of expense per well. It's probably $3 per barrel. And it's probably, on the gas side, I'd say about 30 cents to produce. That's a general fee. Again, I would highly recommend looking at and diving into some of the midstream, but that's kind of a classic variable expense for gas. We've got our model fixed up. We've got oil at $3 a barrel. We've got gas at about 30 cents an MCF, and we've got about $10,000 a month worth of fixed expenses. We're going to go call this Eddy County expense model. I'm going to save as. I'm going to go ahead and use it. We're going to come over here to production taxes. I'm going to go ahead and say, okay. New Mexico. Call this New Mexico taxes. Save as. We're going to use the model. And now we've got everything in here that we need to go ahead, besides our forecast. How stupid. Now, we've got everything we need to run. But what we need to do now is load in our actual working and net royalty interest. So let's go ahead and do that. So now we've got it downloaded. We'll go ahead and click. Bring over our model. So we've got everything here. And we're just going to copy and do a quick copy, paste. Whoa. Go one here. Perfect. We're going to go file. We're going to save. We're going to come in here to our PUD and we're going to say ownership and reversion. We're going to save. We're going to import. Choose file. Go back into, where was it? PUDs, here we go. We'll call it Wolfcamp ownership and reversion. Start the import. And now you see, we have our new working interest. And now we have everything we need to do this. Run the scenario and see what it looks like. All right, here we go. Stu, it's generated. We've got everything that we need to do to answer the question, what would we pay? So we've got our gross volumes, we've got our net volumes, but we need to come all the way over here and look at our discounted cash flows, which really are, if you come over to monthly, you have an idea of what your cash flows look like. But what I like to do even better, let's just go export our aggregate cash flow that's generating. So you could look through all these numbers, or as I like to do, Combo Curve just makes it easy and generates a summary for you. And this is, again, where we need to look. We've got everything we need here. You've got the number of wells. You've got all your volumes, cash flows, realized pricing, operating incomes, net investment. And then the ultimate question is your before tax cash flow. You have an IRR percentage. And what is this telling you, Stu? This is telling you that for an acquisition cost, that's about as much as you'd want to spend.
Wow.
The 3,000. So this gives you everything now you need to know to make a decision. Now, the question is the acquisition even worth? The question I'd be asking in this scenario is this project even worth acquiring? No one's going to give it to me for free. What's the buyer want for it? If the buyer wants anything more than $300K, there ain't much meat on this bone. But that is how the power of both of these tools can lead you in quick. I mean, both of these parts were 30 minutes. So we spent an hour right now, guys, diving into what this deal looks like. And we're able to come to a conclusion quick. There's a lot of other stuff we could do. This was a bigger deal. You could argue we'd dive into more stuff. But what does this tell us? There's meat on this bone. How much, though?
At what price?
And at what price? So we appreciate you guys checking out our first go at this. We may try to, some of these are going to be in two parts, some like this one was. Some of them will be in one part, like minerals deals. There's no type curves. There's some other things we want to dive into specifically and some of the features of this stuff, but look for these to be coming out. Probably try to get out 2 a month. Not sure what that frequency will look like, but love putting these out there. Stu, you got anything else?
Oh, you bet. We even will do these for folks as they need them. Contact us, and we'll be glad to do these with you.
If you want one of your deals of value, if you want Stu to eviscerate your deal live, let us know. He'll come on here and do it. He'll throw out bad management, bad numbers. No, I'm just kidding. I'm kidding. We would love to evaluate anybody's deal. Call us up, and you could be featured. But until next time, guys.